Awesome. Let's get started, everyone. I want to say welcome to today's presentation, using your IRA to passively invest in real estate. So I want to welcome all of our followers, all of our listeners, all the people who may be watching this recording on YouTube. My name is Brian Alfaro. I'm the Director of Investor Relations here at Headway Capital. And we do these webinar series on a monthly basis to better educate our investors, to show them how they can leverage commercial real estate, multifamily real estate in our instance, to grow their wealth, to generate passive cash flow, and to ultimately achieve their financial goals. So today we have some awesome guests on the show. I think you're going to really love today's topic. We're talking about self-directed IRAs. One of the top questions that I get from investors is, how can I invest into these types of projects? And a lot of people think that investing cash is the only way. So we're going to talk about something really exciting, really interesting today that I recommend you definitely look into, and that's using retirement funds like an IRA, for example, to passively invest into our type of commercial real estate opportunities. Well, I'm not an expert, which is why I brought a couple of experts onto the stage today. So we're going to hear from Joe and Matt over at CamaPlan, and it's going to be a great webinar. So let's dive right in. Just a quick disclaimer. This webinar is for educational purposes only. Obviously, we recommend you consult financial advisors, attorneys, CPAs before you make any investment decisions. We're just here to educate you and make you a smarter investor. A little bit about us. If it's your first time joining us tonight or watching this recording, I want to say welcome. My name is Brian. As I mentioned, I'm the Director of Investor Relations here at Headway Capital. And what we do is we help investors build and protect their wealth by providing them passive cash flowing investment opportunities in the multifamily space. These investment opportunities come with equity upside, so your money gets to grow while you do none of the hard work, and of course tax benefits as well, which we're going to talk about a little bit today when it comes to the IRA side of things. Our team has extensive knowledge vetting and in acquiring and operating these types of multifamily assets. We've been around since 2018. Our company was founded by Sid Shamim and his lovely wife Anam Omer back in 2018. After they had been investing in single family space for quite some time, they owned 30 plus houses and decided it was time to transition into the commercial multifamily space, got some education, and they were off to the races, did their first syndication back in 2018. And I got into the multifamily space back in 2020, right before COVID. Great timing. I got to see the highs, and I also got to see some of the lows. So it's been an interesting cycle for the last 5 years, but it's been awesome. It's been educational. I've made a lot of great relationships, and I love what I do. And last but not least, Mr. Umar Naqvi, he's our CFO, CIO. He makes all of our properties go. He's the one who's watching all the numbers to make sure that our assets are performing like our investors expect them to. A little bit about us. Again, we have a little over 456 million of assets under management, a little over 30,000 units, give or take, and we shoot for a 25 to 30% average annual returns. We like to try to double our investors' money when possible. And we have over 500 active investors that have invested with us before. You'll see here on the screen some testimonials from some of our previous investors, which we're always really proud of. And again, the types of properties that we do everything from value add, which you'll see from Watermill, those older 1960s properties, all the way to newer assets like you see here, Independence Heights and Esperanza Queenston. These are newer construction properties that were acquired in 21 that we like just because they were still new. Doesn't mean there wasn't a value add play there. So we try to touch anything and everything that makes sense financially. Without further ado, I want to turn it over to the experts here, Joe and Matt. Matt, you and I had the pleasure of meeting. I don't know how we met, maybe an email exchange, maybe LinkedIn. I feel like it was at least 6+ months ago. We met in person at the Best Ever conference recently, which was great. Always great to shake hands and meet in person. And you've been a huge resource for all of our investors so far that are newer to the space, that don't know how to get an IRA account, how to set up a self-directed IRA, how to answer some of the more technical questions, which it's not my expertise. So I'm excited to have you on the webinar. I'll let you guys take over.
Awesome. Well, thank
Thanks,
you very
Brian.
much. I'm gonna pull up my my screen here as I'm talking, but I want to say that we're really happy to be have this opportunity to speak to everyone in your network here and talk more about self-direction, which we get pretty excited about when we're getting into it. So bear with me for a moment. All right, and can you see my screen, Brian?
Not yet.
See.
There it is.
There we
I think
go.
we got it.
It's
Beautiful.
coming.
Cool. All right.
Yep,
Thank
you're
you very
good.
much. Beautiful. So as Brian generously mentioned. I'm Matt Moore. I'm also joined by Joe Fulvio. We're part of the CamaPlan team. So CamaPlan is a self-directed IRA administrator based out of Ambler, PA. Before we get started, we have our own disclosures, of course, similar to the one you just saw. We don't provide investment advice or endorsements, and all the information in this presentation is for educational purposes only. So as Joe would say, there was a lawyer somewhere who told us, hey, we want to let you know that you need to make your own investment decisions and talk to your own financial advisors, et cetera, everyone on your team. We're not providing that advice, but we just want to give you some information about how to use a self-directed IRA when investing. Just like I mentioned earlier, CamaPlan is based out of Ambler, PA, which is about 30 minutes northeast of Philadelphia. We celebrated our 20th birthday in August, and the company was founded back in August 2004 by a brother and sister combo, Carl Fisher and Maggie Polisano. They're still very involved in the company, and they hold portfolios themselves. And the reason why I bring that up is because they deal with a lot of financial professionals, and they know what they like and they know what they don't like when it comes to customer service. And so they've tried to make CamaPlan a place that they'd want to do business too. So as a result, customer service has been a cornerstone of what CamaPlan's business model is all about. And part of that includes providing education to our clients, as well as education to other professionals across the country about how to effectively use self-direction for an investment strategy. So today is really about providing some really baseline knowledge, and as we get to the question and answer portion of the presentation, we can get into those nitty-gritty details, but we want to make sure that we're all on the same page about understanding what a self-directed IRA or 401k is. And first and foremost, we want to call out that the self-directed portion, it's really just an adjective. It's a description. So there aren't any differences in terms of the tax benefits in a standard IRA that you'd get through a brokerage like Fidelity or Schwab versus a self-directed IRA that you get with CamaPlan, for example. The self-directed portion of it really just refers to your ability to invest into a number of alternative investments, or as we like to say, it's investing in what you know, understand, and can control versus using hope as your strategy. And this quote actually comes from one of our clients who had been invested through the stock market through his 401k for a long time, and really capitalized on the opportunity to use a self-directed IRA by investing into real estate. So to talk about the types of self-directed IRAs, I'm actually going to turn it over to Joe because I think he covers this really, really nicely.
Yeah, sure. And thanks again, Brian. Appreciate being on. Yeah, they fall into two basic categories. I think a lot of people are familiar with traditional IRAs. You may have had one, you may have one now. There are variations on that traditional IRA that are made for companies like the self-employed plan IRA or the simple IRA. And the defined benefit plan, which we used to call pensions. You don't see too many of them anymore, but they are around. And the defined contribution plan, which is basically a 401k. The thing about these types of accounts is the government incentivizes you to put money away for your retirement, and so you get a little tax break when you put money into these kinds of accounts. The hook is that the government is essentially subsidizing your savings plan, and we liken it to subsidizing the seed that you're going to plant in the ground, and you're going to grow a crop, and you're going to tend it, and you're going to make sure that it's healthy, and then you're going to harvest it, and you're going to share some of that with the government as you begin to withdraw those funds in retirement. The original thinking was that you would be taxed at a lower rate when you entered retirement. You'd stop your prime earning years. You'd not be making earned income. This would be passive income. But a lot of people are finding out that, gee, my taxes are still pretty high. I've retired 5 years ago, but I'm making enough money that I'm still on a fairly high tax bracket. And that's why we like the types of accounts on the right-hand side of this. And these are, you might be familiar with the Roth IRA. You may not be familiar with health savings accounts or education savings accounts or that you can have a Roth like 401k, but those are all available. The thing about this is the government does not subsidize. This is all after-tax money. So you put this money in there, you're essentially buying your own seed, you're planting it in the ground, you're tending it just like you would on the accounts on the other side of the page, but you get to keep it all. And we do a lot of comparing investments, and Matt's going to get into this tonight, is we compare a lot of investments, how they perform inside of the tax-free Roth versus outside of the IRA tax-deferred and tax-free savings. And it's amazing. We get between 25 and a 40% bump in your earnings. So we're big advocates of the Roth. If you can get your what you have in traditionals converted into Roth, we're bullish on that. But again, basically, it's on the left-hand side. You're getting your seeds subsidized. You're going to share with the government. You're also going to be told to take that money out when you hit 73. That's the age now. In 2033, it's going to go up to 75. On the Roth side, there's no limit. You don't need to take it out. And so you could take the whole thing out the day you turn 59 and a half, which is the minimum age for IRA distributions, and go buy an island somewhere if you wanted to. But you don't have to take it out. And a lot of people use this as a legacy device to pass along to heirs. So that's basically the difference.
Nice. So we talk about the taxing or subsidizing the seed versus taxing the harvest later on. And to kind of take that a step further, this is just a bar graph showing what a portfolio would look like if you're using taxable income, so like W-2 income, which is represented by the blue bar, a tax deferred account, which is like a traditional IRA, or a tax-free account like a Roth IRA. So that would be the dark green bar. And we're assuming about a 10% return on this. So over time, you can see how the light green and the dark green bars, they grow substantially because of a combination of the tax savings and then being able to reinvest that money to make it work again. Now, as Joe mentioned, the government will get their share on the tax deferred portion. So in 40 years time, the light green bar does actually grow to the same amount as the dark green bar of about 2.7 million. But when you take that distribution, you're gonna have to pay taxes on that. So that's the reason for the difference there. Now, some of you might be looking at this and saying, okay, that's all well and good, Matt. 40 years time, that's not my timeline. You got to show me something more compelling, a little bit more short term. So that's where we want to focus on a more short term example. So this is a deal that was actually offered by Headway, and my understanding is that it just closed in December. So congratulations, Brian, and to the rest of the team for making that happen. And if you're an investor in this, congratulations for being part of this. So this is just a good example, though, a real live example that we can look at. So a quick rundown of the scenario. We're looking at an investment of $100,000 with a cash flow of about 8%, a 5-year lockup, and we're projected 2.2x equity multiple. And so from that preferred return, we're projecting about $32,000 in cash flow from the equity share, about 190K, total take home about 221,000. Okay, so that's our scenario here. So if we put this inside of a tax-free Roth IRA versus making the investment through a personal funds, we can see what makes this very, very compelling when it's inside the tax-free Roth IRA. And specifically, it's going to be the income tax, which we're assuming a 37% tax bracket, and the capital gains tax, where you're really going to be keeping a lot of that money when you're using the tax-free Roth IRA. Now, I will call out, I don't want to be disingenuous, that there is some tax liability when you're using a Roth IRA for certain real estate investments, including if you're a limited partner in passive and investing passively. And what I mean by what I'm referring to is the unrelated debt finance income, which is going to be on the left side, the UDFI. And so that just has to do with that tax that you are assessed, that the government assesses on your account, even if it's in a tax-free Roth IRA, when a project is using debt as a part of it. Now, the good news is that you can actually get some depreciation on the debt portion, which will reduce your tax liability, but you do have to pay some portion of it. But even still, you can see that the total net return when using the tax-free Roth IRA versus using just regular personal funds, it's very, very significant. So um, right off the bat, even in 5 years, you can see, wow, there's a lot more. There's a lot more money to be taken home at the end of the day if I'm using a tax-free Roth IRA. Now, if you are looking at, needing cash flow today, or you're depending on that income, and you're not able to take out distributions yet from your retirement account, so you're not yet 59 and a half, that's of course something to consider. You're not going to be able to touch that money, because that all that return is going to be going into your tax-free Roth IRA. So while this is a side-by-side comparison, obviously for whatever your strategy is going to be, needs to make sense with what your needs are. So we like to just kind of point that out to say that yes, there's money that you can definitely be a lot more money you can be making in the tax-free Roth IRA example. But at the end of the day, it's going to be about what makes the most sense for you. And also, the other thing to consider is that when you're thinking about investing a deal like this Ashford Park Apartments deal, it's going to be not just making the decision between, do I use personal funds versus using qualified funds, but it's also, do I want to leave my money locked up in the stock market through whatever my 401k is in, or is there an opportunity to make a different choice about how I'm going to be directing my retirement capital? So it really comes down to control. So I'm going to keep on moving along here. So there's a number of investments that you can make through a self-directed IRA. These are the common ones that we see at CamaPlan, but by no means is this the entire list. But just to run through them, you can invest in real estate, so you can buy real estate through your self-directed IRA, any number of assets. You can lend from your self-directed IRA, so you can be the bank, and you can make loans for mortgages, or you can do convertible notes, discounted notes, secured, unsecured. It's ultimately up to you how you want to structure those deals. You can do private placements, which would be like the Ashford Park deal I just showed you. Um, Often there's going to be a subscription agreement involved, something like that, syndications, things like that. And then, of course, there's precious metals, which you're able to hold through your self-directed IRA. So, Joe, why don't you walk us through a little bit of the bad news? We'll call it.
Yeah. This is the list of things you can't invest in is blessedly short. The list of things you can invest in is pretty much up to your imagination to a point. There are, being the IRS, of course, there are rules, lots of rules. But it's basically stuff that's highly speculative, where the values can be disputed. The IRS requires you to provide fair market valuations for hard to value assets. That's like not stocks and bonds, but apartment buildings. And we got a guy with a dump truck in his IRA because he leases it out to construction companies, so that needs to be appraised or given a value at some point. But this stuff they prohibit you from doing. Now, that said, there's some changes going on, like with the works of art. There's a company called Masterworks, and they have an LLC that you can invest in, and they buy and sell and auction and trade art or fractional shares of fine art. So that's kind of a workaround for the art. But basically, no, you can't put your 1961 Chateau Petrus in your IRA, unfortunately, or any of the numismatic type coins. This would be the Roman coins or anything from the Civil War or something like that. You can, however, put sovereign minted coins such as American Eagles and Canadian Maple Leafs and Chinese pandas and Krugerrands and all that stuff. So and basically some of this is done for protection. The IRS, again, these are highly speculative investments. They can be valued wildly differently by different appraisers. So that's primarily the reason why you can't do these things. Do you want me to continue on with the
Yes,
prohibited
please.
transactions?
Yes,
Yeah,
please.
there's a chart that goes right. It's usually between this slide and the one you just had on. Yeah, there it is. All right. Again, this being the IRS, there are some rules about who you can do business with. For whatever reason, you can't invest in, or these people can invest in you if they fall within the blue squares here, the blue rectangles here. So lineally, basically, you can't, and somewhat sideways. My wife cannot invest in my company. I can't invest in hers. I can't invest in things that my children do, and on and on. You can see for yourself. Um, there is a distinction, though. I can invest alongside of them in anything. I do this with my wife all the time. We'll find a note, and she has stuff, money in cash in her Roth IRA, and I've got some money, and we just go ahead and we do it. And you can also pair your money up with money outside of your IRAs and put it together and go into a deal. So, I'll give you we don't know why this chart ended up the way it is. I suspect with the people who got in the room and cooked all of this up, wanted to protect various franchises that they'd built into their family's investment history. We don't know, it's like the tax code in general, where's no opportunity for graft. Well, what's it matter? Um, I'll give you one example. My nephews each own their own companies. One is a specialty steel welding company for pharmaceutical and oil field in Texas. And when he got started, he needed plasma welder or another plasma welder, and I financed it out of my IRA. I loaned him the money. He paid me a fair market rate of return, and it was a great deal for him and a great deal for me. And I've done the same with my other nephew, who is in somewhat related business of his own. So those things you can do. Uh, there is another set of rules about, and I think we can go on to the next slide. There's a lot of detail on this particular aspect of investing, but go ahead, Matt. You can go to the transactions prohibited. Basically, the rule is no self-dealing. That's a general rule. If you're on either side of the transaction, it's probably not a good one to do. Although we say go talk to your tax specialist, go talk to your CPA, talk to an attorney if you have to. We get a lot of people who come in and say, well, I've got this house I want to sell to my my IRA. You can't do that. Um, you can't use anything that's in your IRA. It has to be a passive investment. So we get a lot of people who say, well, my daughter's going off to college next year. We're thinking about buying a condo. Her roommates would pay the freight and she'd get to stay there for free. Unfortunately, you can't do that. We get the same thing for vacate properties where people think, well, I'll buy a vacate property and I'll get to stay there 2 weeks out of the year. And you can't do that. So, and when both of those instances come up, we'll always get well, how do they find out about it? And you really don't want to test them on this because you go back to Egypt and you look at those hieroglyphs, and you got the guy with the cat o' nine tails beating on the other people. That's the tax man. So they've seen everything. So if you think you're going to get clever with them, it's not worth it because the fines would be the fine and the risk of losing your investment would be too high. You've got a vacation property. It's right next door to what seems to be a very nice guy. You let on to him after a couple of beers that you bought this property and you've got it in your IRA, and oh, how clever you are. And then there's a property dispute a couple of years later, and he knows that that's not allowed. You're not allowed to be in there, and he drops the dime on you. Divorce, that's another situation where, we see that stuff fly apart. So basically, no self-dealing. And the same thing comes with ventures, business ventures. We have a lot of people say, hey, I'd like to take my IRA and invest it in a company that I'm going to start. And the rule there is you can't own 50% or more of the company or be in control of the company. And receiving a paycheck from the company is a big no-no. It's not a firm bright line disqualifier, but if you're involved in the company as a partner, a minor partner, you own 10% of it, and you're not being paid by it, and you're not controlling the company, like you're not the spider at the center of the web with 5% of the shares, but you really call all the shots. Then you can do it. But so generally, again, if you're on either side of the transaction, it's probably not going to fly. So that's the short story, and we have a lot of resources at the website that we can share with you. But when you get in a situation, if you got a question about that, again, go see your tax advisors and your accountants.
Perfect. So we walked through what a self-directed IRA is, how you can use it, how investments can perform in it, of course, what you cannot do and who cannot benefit from it. So then now I just want to kind of finish things up and walk through how the whole process works if you're going to open up an IRA with CamaPlan. And we'd like to say it's as simple as one, two, three. So you're going to open up your account. You can do that online. It takes about 10 to 15 minutes. Once it's open, the next step is to fund that account. So there's basically three ways that you can fund your account. There's going to be just new money. Those are contributions. So those are it's a $7,000 limit annually. But where we see most people sort of really making big contributions to their account and getting things started is going to be through a transfer or through a rollover. So a transfer is going from like account to like account. So for example, let's say you have a traditional IRA at Schwab and you open up a traditional IRA at CamaPlan. You're going to let us know, you're going to provide us some information, and then we're going to reach out to Schwab, let them know that there's transfer's been requested, and the money will ultimately make its way directly from Schwab over to us, and your account will be funded that way. If you're going to do a rollover, that's when you have one kind of account going to another kind of account. So let's say you have an old employer, someone you're no longer with, or let's say that you are still with that employer, and you have a 401k there, but you're over 59 and a half, so you can access that money. So you're going to go from a 401k, and let's say you're going to put it into a traditional IRA. So you are actually going to be the one who contacts your plan administrator there that's controlling the 401k. You're going to let them know that you want to roll the money over to CamaPlan. They will send the money over to us. That usually takes about 2 weeks. They're doing the right thing by crossing all T's and dotting all I's. But ultimately, the money will make it over to us. Your account will be funded. Okay, so we're done with step one. Now it's time to go to step two. This is pretty quick. You complete what's called a asset purchase directive, which is you letting us know that you want to send your money to the investment firm. For example, you're going to send it to Headway Capital because you want to participate in one of their deals. You also initial the necessary documents, the subscription agreements, things like that. And then CamaPlan, will actually sign on your behalf the investment documents and send the money over to Headway Capital in this example. So the title of that investment won't actually be your name. So if it was me who was making that investment, it wouldn't be Matt Moore. It would be CamaPlan FBO for the benefit of Matt Moore, and that would be the title on that investment into this Headway Capital deal that we're talking about. So then the money gets sent over, and ultimately it's put into the project, or you buy the house, whatever you're doing, and you're working, and that's pretty much it. Anything to add to this process, Joe?
Just that the first couple of sub steps that Matt just went through, opening the account and getting a transfer kicked off, really it takes about 15 or 20 minutes. And so you're pretty much through, a good bit of the process. And once the transfer is submitted by us to the other financial institution, you wait sometimes a few days with the big houses, sometimes 2 weeks with some of the smaller houses or with some of the pension plan people. Um, and during that time, you can go ahead and wrap up your getting your paperwork and your documents signed with Headway. You can get the subscription agreement and operating agreement, all that stuff teed up and signed and then digitized so that when the funds hit your account in a couple days or 2 weeks, you submit what Matt just described in step two, which is the asset purchase directive. That tells us how much to send to who for what reason, and the what reason will be the documents that you upload during the process of filling out that digital form. So we try to keep it easy. It's less complicated than it looks from the outside. And what we found after 20 years is it's just better for us to just kind of do it for everybody because it's bewildering. If you've not done it before, it can be a little bit confusing, but we walk them through. We've got people that'll get on the phone with your clients and help them open that account, help them get it funded, help them with the documents for the investment. So
Nice. So the last question to answer is like, what does CamaPlan do? Well, first of all, we are checking a box that the IRS requires. So if you're going to open up a self-directed IRA, you need to have a custodian or an IRA administrator in place. So we're serving that point first and foremost. We are a neutral third party, which is what I mentioned in the disclosure at the beginning. So no investment advice. But that also means no investment sales. So we don't have a mutual fund or some kind of index that we're trying to show you and sell you. So we actually think that this is a value add. We're not going to tell you where to invest your money, but we're not going to try to sell you on anything either. So it's fully up to you to how you want to deploy your capital. And really what it comes down to is helping you unlock capital into being able to deploy that capital into alternative investments that you may not be able to access through your standard brokerage house. We do keep records of all transactions, report to those to the IRS, so we make sure that everything is compliant. And we finally want to be part of your core team of professionals. So it's not about just a relationship with you and CamaPlan. It's about CamaPlan and you and your CPA, your tax attorney, your lawyer, your advisor. We want everyone to be on the same page so that everyone's comfortable and aware of these investment decisions that are going to be made through the self-directed IRA. And that wraps us up, Brian. Love to answer any questions that might have come up or any questions that you get often.
Yeah, no, this is awesome, guys. I think a lot of the uncertainty, if you're first time hearing about this, maybe you've never invested with an IRA before, you didn't even know this was possible. I think this is very eye-opening, seeing especially the dollars. The dollars are a really powerful thing to see when you see the difference between investing with cash versus investing with an IRA. It's a really powerful thing. Again, I remember the first time I heard about this, I honestly couldn't believe it. It's kind of like a hack, right? That you wish more people knew about.
Yep.
But I'm curious, if first of all, if anybody has any questions, please put them in the chat. The first one I got, a good one, Roger. What are your fees? Tell me about CamaPlan's fees, which is important to highlight, right? Everything, you guys are in business, you guys are here to make money, as in our investors are. Well, what fees should they expect to have to pay setting up an account, funding an account, things of that nature?
Yeah, great question. So we have a full fee schedule, but really what it boils down to is a $300 annual fee and then a one-time $150 fee when you make an investment. So let's just use that Ashford Park deal for example. Let's say you're going to put 50K into that deal. You would pay CamaPlan $150 to when you fill out the asset purchase directive. It would be charged when we're processing that, and then when the once the investment is made and we're now holding that asset, you would be paying us about $300 annually. So I'll point out a couple things here that $300. If you go look around at other custodians, we're not the cheapest. We're not the most expensive, certainly not the most expensive, but we're not going to be the cheapest. But where we think our fee structure stands out is when it comes to, it's the value proposition when it comes to the service. So what do I mean by that? Well, number one, typically we only charge a $75 account setup fee, but for headway capital investors, we'll discount that to just $1. So you're going to pay $1 to set up your account. And as you mentioned, Brian, we're running a business, so we are trying to make money. But the reason why that's compelling is because we're not making a bunch of money on the account setup fee. It's just that $1. So really our skin in the game is to make sure that our clients are happy. So, and if we want to get paid, we want to make sure that our clients stay with us so that we can continue to make those annual fees. The other thing I would add is if you go look at some other custodians, you'll see about $250, $350 annually, similar to us, but they might have like additional concierge services or things like that. And that allows you to have a phone number that you can call when you have questions or kind of jump to the head of the line if you need to talk to someone. And those can range from $100 up to $200 annually. It's like a subscription service. So now we're no longer talking about $300. We're talking about more like $400 to $500 annually if you want those services. We don't charge any concierge packages or anything like that. With that $300, you call us, we answer the phone. We don't have complicated phone trees. We don't have big call centers. We are a company that still answers the phone. And so when you add that into it, now I think our pricing and our fee structure becomes a lot more competitive, because we want our clients to be really, really happy.
Absolutely. Nope. That's a great point. Customer service is key. And I will tell you, I think part of the reason we hit it off too, Matt, is, and maybe some of our investors here can attest to this, there are a lot of really frustrating self-directed IRA companies to work with. I mean, nobody's perfect, right? But their customer service is huge in this space because it is competitive and investors do have choices. So the best way to stand out is by offering great customer service, which is good to hear that you guys are keeping that top of mind.
Yeah, and I will just, I'll call out another custodian, but in a positive way. We're aware, we know that Quest is very, very popular, or was very, very popular in Texas, and so and a lot of people, a lot of clients of Quest were based in Texas for that reason. And our founders go way back with the Quest founder Quincy. So one of the things that they kind of see eye to eye on is being very, very customer forward in that way. And so we have been pretty popular with folks who are no longer with Quest, because Quest closed shop, or they were bought out. But we
Yep.
see that we're a pretty good matchup for folks who are enjoying the service that they got from Quest and who are looking for that same sort of relationship driven experience that they're now getting with CamaPlan.
Absolutely. Absolutely. Another question coming in. If you are using a deferred IRA to draw funds and set up self-directed, all funds from the selected investment stay in or behind the IRA versus going to investors. True. So your balance grows, but you still have to pay taxes when you pull the money out.
I'm not sure about when the person asking the question is referring to a deferred IRA. Is that something that is, I'm not sure about that terminology. What does that mean?
Yeah, it might be a little bit of confusion here. So perhaps, Tammy, I would recommend you reach out to Matt. I don't know, Matt, if you have your contact info on the next slide.
I do, yeah.
We'll definitely share that. But oh, she said a rollover, a 401k rollover to IRA.
Yeah, yeah, you can do that. That's, again, the typical scenarios that you've left that employer or the employer allows it. It's part of the rules. Generally, they don't. But yeah, you would roll that over from that employee plan or employer plan into an IRA. That would be the appropriate vehicle for
Right. And
moving
then
the
the
money.
balance is going to grow within that IRA, right? And then once you pull those funds,
Absolutely.
you will pay taxes eventually.
Right. It's not a taxable event moving the money from the 401k to the IRA. It's only when you begin withdrawing the funds, and then you'll pay tax at whatever the tax rate is for you that year, the year in which you make the distribution. Again, if you 59 and a half, you can do the distributions as often or as much as you want and just pay at the tax rate. If it's under 59 and a half, there is a 10% penalty on top of that. So just keep that in
Good
mind.
question. And this is more for me. I'm just curious. We do have a couple questions. Is there a RMD, like a required minimum distribution for IRAs?
Yes, the traditional IRA has a required minimum distribution. It begins at age 73 now. It'll go up to 75 in 2033. And it is based on the amount of money you have collectively in your IRAs. So you're going to have more than one, and the mortality tables that the IRS publishes from time to time. So it's kind of a little formula. The IRS has a calculator that can give you some heads up on that, so you're not completely surprised by how much you have to take out. But yeah, it's based on how much you have collectively in all of your IRA accounts, your true non-Roth accounts, and then you're likely, whenever it is, you're going to shuffle off this mortal coil. So
Got it. Perfect.
and you'll want to maintain fortunately you can make contributions past your, as long as you have earned income, you can make contributions into these things, because what will happen sometimes is people will run out of cash to take the distribution. So you got essentially an apartment building sitting in your IRA, and you're required to take a minimum distribution, and you can't just sort of saw off one
Yep.
corner of the building and sell it off.
I gotcha. I
Yeah,
gotcha.
you can't sell it off to somebody to raise cash. That's a whole nother bailiwick.
Yep. Yep. Roger wants to know, what forms does the client have to send to the IRS each year being when you're using this tool? Any forms they have to
Um,
do, or do you guys handle all the paperwork?
we do all that. If there's distributions, it's a 1099, and we handle all that. If you make contributions, it's a 5498. Those get generated by us. You get a copy for your tax prep specialist, and we file that with the IRS. Your investment sponsors will send out 1099s or K1s, depending upon the structure of their investment. Those get sent to, we try to arrange so that gets sent to us on your behalf because it'll go in your file. But yeah, there's nothing you need to do. It's just it's like any IRA you might have had at Schwab or Fidelity or Vanguard.
Perfect. Perfect. Karen wants to know, if you have a traditional 401k with your current employer, do you have to be a certain age to move it to self-directed?
No, as long as you're allowed to move it, you can move it. It's not a distribution, so you don't have to be 59 and a half. So it's whenever. We have people who have had positions at different companies, throughout their career, and they've got two or three of them sitting around.
Yep. Yep, makes sense. That's all the questions in the audience, guys. Please keep dropping them in if you have questions. I had a question, I guess, for you guys since you're in this business every day, or I guess sort of a statement. Maybe you guys can speak to this. I think one of the problems I've dealt with in the past is people love this idea, they love this vehicle, they want to do it, and they kind of wait till it's too late because we all know time is of the essence when these deals open up. So if Headway has a new investment offering, our windows are typically 30 days to raise capital. Could be a little bit less, could be a little bit more. Let's just use 30. If they are interested and they wait a week after the deal launches to call you, Matt or Joe, and say, hey, I want to invest in Brian's deal. I'm ready to, set up this self-directed thing. There are certain things in the process that are out of your control, for example, right? Like you guys are going to move as fast as humanly possible, but there are some things that are out of your control, which could mean that there's, in theory, they could miss the deadline or even miss the opportunity. So can you speak a little bit to, like, not to, create a false sense of urgency, but if you're interested in this and this is going to be a vehicle you want to use, getting on that discovery call, getting your questions answered, getting it set up now so that throughout the year you're ready to rock and roll. What do you recommend as far as like mindset? Don't wait till it's too late.
I mean, really all of the above that you just said, because you want to be as ready as possible, especially if it's a short funding timeline. You want to be as ready as possible so that you can get the capital over to Headway, for example. Now that said, when you have your money it's sitting in a CamaPlan account and it's not deployed, it's not going to be, it won't be working. So you don't, that's kind of something to consider, is that you don't just want cash sitting there doing nothing while you wait around for the next deal. So I would say that, having the conversations about how everything works and, getting your CPA involved, or getting your advisor involved, or whatever that needs to take place on that side, definitely do those ahead of time so that when you are ready to participate in the next deal, and there's, Headway's going to do a multifam in Houston or something like that, and you want to participate in that, you're ready to have CamaPlan get the process started. You already have your account open with CamaPlan. That's, that's nothing, that your account will be there. It will be unfunded. That's no problem with us, but it's just one step that you can have taken care of so that when it's time to get the money from your old 401k or from your existing IRA at Schwab or wherever it is, it can just move along that much faster, and the money gets into your CamaPlan account that much faster.
I agree.
That's
I agree.
that's a good point, because we get a lot of people who have TSPs and public pensions, and they move a little slower there. I had one teacher, she retired and wanted to get into the same investment as her husband, and she filled out the paperwork, got everything done, and then she went over to her custodian, hadn't checked before, and this is in July, and they said next distribution is at the end of the third quarter. So she had
Mhm.
to wait 2.5 months to get that going. So you want to, if you have those kinds of plans and you're not with a major brokerage firm, check with them and just be aware of what the time windows usually are for them to react.
Yeah,
Absolutely.
and to that point, having these conversations ahead of time makes a big difference, because if you are learning, yeah, and I'm just kind of speaking broadly to the audience, if you're learning about this for the first time, or you're learning more about it today, chances are the people who are at the plan administrator at ADP or whoever, the person you talk to doesn't know how this works. And so if you try to start talking to them about what you're doing, they may not know. And there's a good anecdote from someone from our client team, Will. He was on the phone with one of our clients and someone at ADP, and he talked to five people who all said no, and then they finally talked to the sixth person who said yes, you can do that thing, and it was related to a solo 401k. And so you kind of want to plan for um, those kinds of conversations that might take place. And so if, let's say, there is a person who is the plan administrator or is part of the retirement plan that you're with, maybe you want to identify that person and that person's contact information, so that when it's time to go, not only is everything taken care of on with CamaPlan or with your financial team, but you also know exactly who you want to contact, and you know exactly what the process needs to be from where the money is coming.
Perfect. Makes sense. I'm just dealing with that from experience. I know it's painfully frustrating for an investor when it's the other end, on the custodian side, that they can't get the deal done just because they're taking so long or they're unresponsive. So better to get things up, set up early versus dealing with the headaches and the heartaches of missing out on a deal, right? So
Right.
Roger has a question about, if you do a deal inside of a Roth IRA, there is no tax reporting to the IRS each year. Was his question? Is there tax reporting to the IRS?
No, no, and that would be the case with traditionals, Roger, as well. There's no tax reporting what goes on. I mean, we'll have every year you'll provide fair market values, or the sponsor
Right.
will provide fair market values for those assets, but that's it. And really, that's kind of a pro forma thing until you hit required minimum distribution age. But in the Roth case, you're not going to have that. So no, nothing you need to do there.
Awesome. Awesome. Cool. Any other things, gentlemen, that you want to highlight? Maybe, most common challenge that you see, or any other wise words of wisdom you want to leave with the audience who's maybe hearing for this at the first time?
Honestly, the question that you asked about timing is I think the thing that people overlook is timing, specifically in relation to participating in a deal and just getting everything ready ahead of time. So I'm so glad you brought that up, because I think that people, they listen to these webinars and they say this is great, and then all of a sudden they
They get off
it's
and they
not
do nothing.
yeah, exactly, but they get off and they
Yeah.
do nothing, and then
Yeah.
the deal comes and they say, oh, I want to use a self-directed IRA, and I have
2 weeks. Yeah.
3 weeks to participate in this. I'm just going to call. And it's like, we wish it was that fast, and someone's going to come along and create a solution on the blockchain and make
Yeah.
everything way faster. But
We're
until
not there
that
yet.
time happens, we're living in a 2 to 3 week time span to get the money moved over. So to your point, I think the mistake, or the thing not to ignore, is just preparing as much as possible. And it usually starts with a phone call with the CamaPlan team, for us to be able to answer your questions and make you understand exactly how all of this works, so that you feel comfortable with it.
Perfect. Roger's
And
got one last good question. Roger's full of good questions today.
Thanks,
He
Roger.
said, I heard there are discounts in evaluating the transfer funds from traditional to a Roth IRA to allow you to reduce the tax on the transfer.
yes, and it's going to depend largely on the sponsor and the type of investments. There are some investments that can be made that can be discounted. And I don't hold me to this as an exact example and go out and do it and get in trouble. But I mean, take a house that you've acquired and you're gonna gut it and you're gonna rehab it, and then you're gonna sell it, okay? And you buy it, and it's livable, all right? But you take it down to the bones, and it's not livable anymore, and then no one could live there. And so theoretically, that house might be worth less after you've ripped all that stuff out. And there are a lot of what are called Roth, Roth conversion friendly investments out there. And again, get an opinion on it because, for example, if you have, there is no market for the types of things that Headway and other sponsors we work with. There's no market for that. So you could make the claim that I can't get rid of these shares, so they're really not worth what I put in there. But again, look for a sponsor that's built that. We see the same thing with UDFI and UBIT. There are sponsors that build, UBIT blockers into their offerings, and there are sponsors that design offerings specifically for Roth conversions. And I would look for those, and they make a big deal out of them. It's like it's on the front of their deal sheet.
Interesting.
Does that answer that, Roger?
Hopefully. I think it does.
I hope
If
so.
not, Roger, you have their information. Engage at CamaPlan.com. So awesome, guys. Well, we made perfect timing. Matt, Joe, I want to say thank you again for joining us on today's webinar and sharing
Thank
how powerful of a tool IRAs can be when you're investing in private placements. And hopefully our audience will reach out to you and set up some calls to get some questions answered, because everyone's situation is a little bit different. Everyone has different questions, of course. And I definitely want to encourage our audience to reach out to both you gentlemen. Super helpful. And if they have any questions, reach out, engage at CamaPlan.com. Do you guys want to leave with any other ways that it's the best way for them to reach out, or is that email address good?
This email and phone number is going to be the best way. It's going to go to our client team, but they know that we're doing the webinar today with Headway Capital Investors. So you're going to talk to Will or Courtney on the client team. We're big on names, actually knowing who you're contacting when you reach out. Reach out to either that email address or that phone number if you have any questions, and you're going to talk to them. And just want to say thank you to you, Brian, for giving us this opportunity. And we look forward to helping your investors save some money on taxes.
Awesome. Love it. Love it.
Likewise.
Appreciate it,
Thanks.
guys. Have a good night. Take care,
Thank you.
everyone.
You do the same.
See ya.
All right.
Bye.
Take care.
Bye.
Bye.